This is a short video explaining in a nutshell what market profile is. It is being presented by Reza Dilmagani and profiletraders.com. Market profile is a unique way to display market data using the statistical bell curve concept. For example, if you would be in the market to buy a house, what you would do is that you would gather all the info that there is out there regarding the price range, the size of the home, etc. that you want to gather, and then you can possibly distribute the information into a histogram of price. By doing so, you organize the information in a manner where you will know how many homes, for example, sold at each price, and therefore you get a great idea if a price that you're looking at is within the average price that people paid for that house, or is it falling into the categories of extreme on the upside or extreme on the downside. Therefore, if I now take the market data and distribute it into the bell curve, I can extract all the valuable information that the bell curve presents, which is the belly of the curve, where the middle of it is, which is the fair value, and that's the price that most of the participants agreed to pay for that house. Then you have what you call the standard deviation number 1, which contains 68.3% of all the transactions that took place. As a result, if you buy the house somewhere within that standard deviation number 1, you're probably dealing very close to the fair value assigned to that house. Now if you push a little bit further from the standard deviation number 1, you will be dealing with standard deviation number 2, which will contain 95.5% of all the transactions, but you are now far away from the belly of the statistical bell curve, and on the upside of it, that price up there will be a little bit overpriced, and if it's a little bit down there, it's going to be underpriced. And then the last bracket is standard deviation number 3, which is extreme overvalued or extreme undervalued. Basically, this statistical bell curve will give you a great idea of what value has been assigned to the house, and when you are looking at the price of a certain home, you will know if you are paying overly for it or if you are paying under the market for it. Obviously, if you can know that the price of that home is undervalued, you want to jump on it very fast, and if the price of the home is overvalued, you want to avoid it. And every time, if you like to sell it as fast as possible, you have to price it near the center of the belly or at the belly of the bell curve, because that's where the most transaction take place and that's where most liquidity will be at. So if you buy it undervalued, you can sell it at the middle, that will be your profit. If you bought it overvalued and you realize that later on and you try to sell it the fastest way possible, you will have to price it where the belly of the or the middle of the bell curve is, and that difference between where you pay too much for it and where market will be willing to take it back from you will be your loss. Now, in order to be able to fit price into the statistical bell curve, we need to distribute the market data vertically, as you can see on the chart to the left, versus the standard chart that develops horizontally. I cannot fit this in any bell curve, but if I take that same info and distribute it horizontally, I will be able to fit this into the statistical bell curve and then get all the valuable information out of it in terms of standard deviation 1, 2, 3, know what is overvalued, what is fair valued, what is undervalued, etc. Therefore, I am dealing mainly now with value versus price. This is a typical one-day candle. I have the high, I have the low, I have the open, and I have the close. But I do not know what's fair value, what price most participants considered as fair value. I don't know what's overvalue, what's undervalued. All the information that you will be getting if you would use the statistical bell curve. Now I'm going to show you the finished product and all the information that you can gather from it. This is a one-day structure or a one-day market profile. As you can see, there is a ocean of information, all extremely valuable and all extremely important to gain an edge while you do trade. And if you compare now this structure versus this daily candle up there to the right, there is day and night difference. I am not going to take too much time to explain everything and what they mean. That's the purpose of our courses. But it gives you an idea of how much you are missing if you do not have an understanding or access to the market profile structure versus a candle or a bar chart. Thank you for listening.